Hey, good morning, everyone. Welcome to Market Mondays. Hopefully, you guys had a great weekend. I'm going to give you guys a quick update on everything that happened last week and going into this week. So, before we get right into it, though, I'm going to do a quick dad joke. Dad joke today is, did you hear about the mermaid wearing seashells? You know why she was wearing seashells? It's because she outgrew her bee shells. Get it? Pew pew. All right, so getting right into it. Last week, we got some updates in terms of what's going on with the conflict with Iran and the US, Israeli, all that stuff. And then today has been kind of a weird day, too. For the most part, what has happened in the last 2 weeks is that the ceasefire ended and the Strait of Hormuz is, in fact, closed. Now, the question is, why didn't oil prices spike up like they did the first time the Strait of Hormuz was closed? Well, the reason is because a lot of the oil is being redirected through Saudi Arabia through the east-west pipeline going into the Red Sea. Now, a lot of the oil is going through there and it's going north and south through the Red Sea. Now, here's what's tough. Now, that's great because now oil is still flowing. And that's what's been nice about the oil prices staying in around the $84 a barrel. They haven't spiked up above $90 or $100 a barrel like they did before, but it is still showing that there's supply leaving that area to give oil out to the world. Now, the next thing is, the next development that happened was that at the southern tip of the Red Sea, there's a country called Yemen, and there's a group that's backed by Iran that's closing that route down to the south. So right now there's still oil flowing. It's just very restricted because it can't go south. Now it has to go north through the Mediterranean out to the Atlantic Ocean. So that's been tough. That's been really interesting in terms of how this is all going about. What's nice is that oil prices have stayed at $84 a barrel and hasn't done much. That's what's kind of nice about mortgage rates too. They haven't spiked, but they have hit the highest they've hit this entire year. So because of the development in the Middle East and the restriction of flow of oil and the attacks that have been happening since the ceasefire, that's caused a lot of inflationary concerns and also caused a lot of uncertainty of what's happened to the future. As of today, there is a pause on strikes. We don't know what that really means. They're having a new negotiator, new person to help with negotiations. So effectively, we're just back to where we started back in roughly May and June, where they're going to go back to negotiations about peace talks and hopefully figure this stuff out. Now, I did talk to a friend of mine that's very involved with this geopolitical stuff. He is also active duty in the Navy as an officer, and he has done quite a bit of stuff with this. From what it sounds like is that this may not end anytime soon. It may go past the midterms. There is something going on with the U.S. side and the Israeli side that even though it seems like they're talking, there's probably no sense of it actually being concluded at any time soon. So we'll see. Maybe I really hope that what he was told was wrong. I really hope so. But given what we have seen since March and that this conflict had ended, it lasted through June, briefly ended end of June, and then we're back at it here in July. We may see a really long extension of this entire process of negotiating and conflict and all that stuff. So some of it makes sense as to what he found out, but I hope he's wrong. I really do, because I would just want this conflict to end. So that's one thing I want to kind of share with all of you is that we might be in this for the long haul in terms into the rest of the year with this conflict with the US and Iran. And I hope this oil flow continues to go and not go any higher than $84 a barrel. So that's the main thing. And then just taking a look at mortgage rates of what they've done in this entire year. The blue line, for all of you who don't know, those are conventional rates, an average of conventional rates. And the orange line is the average of VA rates. So you can kind of see that, we have higher highs. These spikes are higher than the previous spike. We hit another high within just last week. That's been the highest we've seen this entire year. So we've seen two extremes. We've seen, the lowest we've seen in a long time, probably since September of 2024, back in February. That's where we were at. We're the lowest since we've seen in February. And now we've seen the highest rates that we've seen for this entire year. So that's what's really tough. I mean, we were here back in September of 2025 when it was coming down. but now we're kind of back up to where we were then. Now that's what's up. It's all been with everything that's happened with the conflict, everything that spikes that you see, and sometimes it has to do with the labor market. We're seeing, just spikes happening. And this was supposed to be an expected year of improvement with mortgage rates, and no one ever expected this Iran and U.S. conflict happening. So it's been a tough go. And then one of the things I wanted to share with all of you is different conversations I'm having with clients now in terms of why it's important to buy a house. The conversation that's changed is that it's no longer the conversation of renting is more expensive than buying, not at least not on a monthly basis. So that conversation needs to go away. I personally think that up until at least rates get down to less than 5 maybe. But for the most part, renting is no longer cheaper on a month-to-month basis than buying. And that was never to me, and that was a great conversation to be had. It was a bonus, but in terms of real estate, that's not supposed to be the primary reason in terms of buying a house. Buying a house is all about building equity. So that's what I think a lot of buyers are forgetting, is that the equity that's built for paying into a mortgage. And now my conversations is more about, yes, you can rent and it's going to be cheaper. But the tough thing is that it's 100% interest, which means none of what you pay for goes to anything that's going to help you down the line. So yes, you will most likely pay a little bit more for more of a house, or maybe for the same cost or for the same size. You will be paying more, but in the price of real estate, if you want to make money, you have to pay to play. And the thing about appreciation is about the value of the asset from the previous year. And then once you what I've learned is that once you get clients kind of understanding the value of the appreciation and how it builds equity and what they can do with that equity when they decide to move on with that house, is what's the most powerful tool in real estate. That's what makes real estate extremely attractive, because of that building of equity that could set your finances ahead another 10, 15 years than renting for however long. So it's more about conversation of what it gives you in the end, not so much what it gives you now. Also security, having to pay all this, the initial things you have to pay for when you rent out a place. Mortgage rates or mortgage payments will go up because of property taxes. But yeah, for the most part, the conversation in terms of renting is more expensive than buying is no longer the truth now. It's no longer the reality. So my recommendation is always go toward what they're losing out on and why real estate helps build wealth in terms of appreciation and how it impacts their equity. So that's the main thing I tell a lot of clients. I have to have that conversation with them now, is that, if your house is worth $100,000 today, you gain 5% next year, it's worth 105. Then the next year it's 5% on that 105. And that's how equity is built over time. And it's a compounding, appreciating asset. So I recommend having those conversations with buyers now, because they're not blind to the whole how mortgage rates have been, how mortgage payments have been. It's a way to address that it's a pay to play economy when it comes to building a real estate portfolio. But otherwise, that's all I got for you guys today. Hopefully that all makes sense. If you have any questions, let me know. Be happy to help. Otherwise, nuke out.